Hey, Jason here. Today's video, I'm going to answer the question, should you invest in DeFi company WidePoint, stock ticker WYY? This is an investment analysis piece for Njoomnow, hopefully I pronounced that right, on YouTube, who requested this analysis video. Before I get to that though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms. Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and other videos on YouTube, make sure to subscribe, hit the notification bell so you're notified every time we release a new video. We release new videos all the time. Okay. I'm going to do this disclaimer again. I hate doing it. I have to do it because every time I don't, I get nasty comments. This is for informational purposes only, to help you become a better investor faster. What I'm doing here is I'm showing you a process I've developed with my 15 years of experience to help you sift through subpar companies faster so you can discard them, so you can find and spend more time evaluating better companies more often. This process is so powerful, or this part of the process is so powerful, it allowed me to go through manually research 3,943 stocks in 40 days in 73 different countries. Last year, about this time actually, when the COVID crash was happening. This process allows you to go through companies very fast if you get good at it. Again, I'm sharing this for you. I do not, or to help you learn this kind of stuff. I do not short sell ever, and I do not own stock in any long position that I taught. So I don't short sell any companies I talk negatively about, and I don't buy any companies I talk positively about. Again, this is for your informational purposes only. And again, I hate even putting this here, but every time I forget, I get nasty comments. So there's that. Again, let's get to the analysis of WidePoint, stock ticker WYY. Again, this is for Njoomnow. Hopefully I'm pronouncing that correctly. Let's get to the numbers. There we are. Okay. Oops, that's my personal email. Didn't need to go to that. Okay, so we are on WidePoint. I don't know anything about this company. Again, this was requested by Njoomnow. If you want me to look at a video like this, I usually say this at the end of the video, but if you want me to make a video like this for you, just let me know in the comments below. I'll look at any stock anywhere in the world for you. The only conditions I have is I will not look at banks because I don't evaluate them. I will not look at insurance companies because you have to actually dig in their financial statements and their 10Ks, annual reports, to be able to evaluate them. And this is a new one. The company has to be producing revenue. I don't invest in highly speculative stocks that aren't producing revenue. So, well, again, had some interesting discussions with people in some of the last videos, but the companies have to be producing revenues now as well. Okay, so WidePoint, tiny company, love tiny companies, loves stocks that are sub $500 million. Having said that, though, you need to be careful if you invest in these kind of companies because a lot of them at this range aren't great, which is why, or they're new. Both reasons are why they are typically a smaller market cap. But I love these kinds of companies. PE ratio shows me they have some kind of earnings, which is good. Or the forward PE here shows me at 34.7. I don't care much about the PE or the forward PE, as I'll talk about a little bit more later when we get to the valuation part. But this shows me that not only do they have some kind of positive earnings, this also shows me it's one sign the company might be overvalued. Because I look for anything below 20 here. The price of sales actually is one sign I don't care about at all, but again, the lower this is, typically the better, and it shows they have sales at the very least, and that they aren't, at least on this metric, again, that I typically don't care about, that they aren't valued spectacularly. I think we evaluated a stock a couple weeks ago now that had a price to sales ratio of like 300, and again, even though I don't use the price sales ratio ever, that's a massive sign the company is extremely overvalued. Okay, so what does WidePoint do? WidePoint Corp is a provider of trusted mobility management, TM2, in parentheses, that offers federally certified communications management, identity management, and interactive bill presentment and analytics solutions. I'll explain what all this means, or at least to me what it means and what's important in this, because there's several things in here that it's important. Most of the time there are not. There are several things in here that are very important. The company's solutions include telecom lifecycle management, digital billing communication solutions, and mobile and identity management. The majority of its revenue is earned from carrier services, followed by managed services. Frankly, again, I don't know what most of this means, whoever wrote this. I don't know if it's Morningstar, I don't know about this company. That's a horrible definition of what they do. So let's find out what they really do by going to their website. Hopefully this is better. There we go. Manage the mobile needs of a global workforce. That makes a lot more sense right off the bat. So, okay. So they deal with telecommunication stuff, security stuff, all that kind of stuff. Key point. Let's go back over here. Anytime you see the words federal in a company description, extremely important. Again, most of the time these business descriptions are useless. If you see, this is a major tip. If you see keywords like this, like federal in here, it's a massive sign the company probably has competitive advantages, or at the very least, their contracts are locked in for a long period of time, which generates them long-term revenue and profits. The reason being is because federal contracts typically aren't on a year-to-year basis. They are for longer periods, 3, 5, 10 years, stuff like that. Usually there's some kind of guarantees involved in those as well. There's usually some kind of exclusivity as well. So these kind of contracts are not only valuable in the kind of initial sense where they bring revenue and profits, but on a second, third, fourth, fifth order level with the things I just talked about, plus it also might mean they have competitive advantages as well. So anytime you see the word federal or federally in this case, it's one sign the company might have competitive advantages, or at the very least have long-term contracts and profits, revenues and profits built in. And that is shown further here on their website. WidePoint is also an approved and trusted issuer of U.S. government strong authentication credentials since 1999, and a provider of identity management IDM credentialing services since 2006. So, I'm a military brat. My dad was in the Air Force for 21 years. A lot of my friends are still in the military, or were in the military. I grew up in the military, so I know not a lot. I was actually going to go in the military, so I studied it quite a bit, but I got disqualified because I had a seizure when I was 12 years old, so I got disqualified from that. So I've studied, been around the military and the government for pretty much my entire life to some degree. To become one of these kind of government contractors, you have to be stable. You have to be able to do what you say you're going to do. There's a long vetting process in most cases. And since they've been doing it since 1999, that means they have a strong relationship with the government. That's, again, competitive advantage right there. Another competitive advantage here, again, keywords. Strong authentication credentials. I don't know exactly what that means. I'm assuming this is some kind of security clearance. Again, because I've been around the military most of my life. I know most, probably all military members, I think, that have some kind of security clearance. I know it's expensive to get those security clearances, which again means competitive advantages because of long-term contracts and the stuff that I just talked about. Again, I knew all of this, yes, based on my experience with being around the military and government contractors, or government and government contractors most of my life, just from this one word, federally. Yes, my personal experience comes into that, but that is the power of certain keywords that can show you competitive advantages. This shows the company has potentially huge competitive advantages, or at very minimum, that they have long-term contracts that are somewhat guaranteed in nature, and that they have a very strong relationship with the U.S. government, which again leads to more long-term contracts, more revenue, and more profits. This is interesting. I didn't even see this. WidePoint awarded more than $86 million in task orders from the U.S. Department of Homeland Security. Again, Huge government contract. $500 million ceiling. 1 year. 12 months. So this contract is actually for 1 year to start, but there are 4 12-month options that it will extend or that could extend the deal to 2025. That's what I mean when I talk about long-term contracts. Boom. ICE and the Department of Homeland Security, again, government contractors. All this means the company likely has some kind of large competitive advantage or again, at minimum, very good relationship with the government, which means long-term revenue and the other stuff we've talked about. So we haven't even talked about the numbers yet. We are 11 minutes in, and I spent 11 minutes talking about essentially one word here, federally, and what that led me to looking on their website, and all the stuff about competitive advantages that I've talked about. That is the power of knowing what you're looking for when you look at investments. One word, in this case, we've talked about for 11 minutes now. And it shows the company, or it shows an enormous amount about the company. Now, let's get to the actual numbers. Okay, revenue going up from $41 million in 2011 to $180 million in the trailing 12-month period. And that one contract was for, let's go back to it now, $80 million a year, $80 million total. Let's see. The total contract has a ceiling of $500 million. So this is just the first part of the contract, the $86 million. So this $500 million contract at most will help skyrocket the revenue essentially. So again, the power of government contracts here. Operating income is negative for most of the last decade, and their average operating income margin is low. Again, that's not to be unexpected, frankly, with government contracts, because most government contracts, there's not necessarily a lot of margin in them, because the government obviously wants to pay as little as possible at as high a quality as possible, and they want it to get it done as fast as possible. So the main thing with most of these, yes, defense contractors are a little bit of an exception here, but most government contracts, there's very little margin, so frankly, that's not a surprise to me. It still doesn't reach my threshold. I look for anything about 10% on a consistent basis. But it's not necessarily a major red flag here, as it is in most cases, because for most of these companies, again, you're looking for the stability over the long term. Earnings per share, up and down over the last decade, and that mirrors the operating income. Share count has gone up about 33%, from 6 million shares in 2011 to 9 million shares in the last 12 months. Okay, here's a pretty good sign that the intrinsic value of the company is going up over time. In 2011, their book value per share was $3.55. Now it's $4.51 per share. Again, ups and downs, but now over the entire period, that's what it is. This number is not super important, this book value per share number, because most companies don't operate on a lot of hard assets anymore. But I look at this number to see, it still gives you a basic kind of underlying valuation of what the company is, because book value is the net value after subtracting total assets from total liabilities. The net number there is called shareholders' equity, aka book value. So this is a decent, if conservative, proxy value of the company's balance sheet. I want to see this typically going up over time, because it shows that the underlying intrinsic value of the company is going up over time. There is one caveat to that, which we will get to when we get to the balance sheet. But there is one caveat to that. Typically, again, you want to see this going up over time, though. ROICs are fantastic in the last year, 27% rounded up. Over most of the last decade, they went from decently positive to pretty good. Negative, down on a low of negative 24.4% in 2014. I look for anything over 10% on a consistent basis. So in the last year, they surpassed that threshold, but I look for it again over a 5-10 year period. So they didn't surpass that, but again, not a huge surprise there with the government contracts typically being lower margin. Same thing here for the free cash flow to sales. I look for anything over 5% on a consistent basis. Again, this was up and down, some positive, slightly, some negative. And last year it was 2.9%. On average over the last decade is probably around positive 1%-ish, somewhere in that neighborhood. So again, doesn't reach my threshold, but frankly, not surprising for the reasons I've already talked about. Okay. Accounts receivable are skyrocketing while their inventory is not. That's interesting. So we're going to look at the cash conversion cycle next to see what's going on there. Tangibles are going down. That's at least as a percentage of the balance sheet. We'll see if the actual total numbers are going down. That's interesting though. No debt. That is fantastic. So they have good amount of cash. We'll see what the actual number is, but no debt according to this look, which again is fantastic. It gives you a gigantic margin of safety, especially now when most companies they were forced to take on a lot of debt last year due to the COVID pandemic and shutdown. Okay, cash conversion cycle now. Interesting. So their accounts receivable are going up, but they're selling stuff at a far faster rate than they used to. Inventory levels about equal over the last decade. The main difference here, well, besides that keeps the cash conversion cycle negative, is their payable period is way down from 92 days rounded up in 2011 to 57 days in the trailing 12-month period. That's about the same as the drop in the days sales outstanding from 94.95 rounded up days in 2011 to 51 days rounded up, or rounded down in that case, in the last 12 months. The overall number is the most important thing here, and this went from -1 day in 2012 to -4.4 days in the trailing 12-month period. What that means is the company is making money and earning cash flow before they have to pay their suppliers. That's a very good thing. Companies that have that are typically huge companies with massive competitive advantages like Walmart, Amazon, stuff like that, that have cash conversion cycles that are negative. When you see this, it's a great sign typically that the company is wildly efficient. Days sales outstanding and the payables period outstanding. What does that mean? Days sales outstanding means they're selling stuff faster, at a faster rate. Payables period going down means they're having to pay their suppliers faster. That can be a red flag, because typically when payables period drop by especially that much, it could mean that their suppliers that they're buying from are essentially forcing WidePoint to pay for their supplies faster. Maybe they were late on some payments, maybe the inventory, or maybe there is a supply issue. I don't know. Typically that's a red flag though. In this case, I would say it's not at this early stage, not necessarily a problem at this early stage. Maybe they just wanted to pay faster. It would be a concern if payables period dropped this much and the inventory levels and sales outstanding levels skyrocketed. That did not happen. That's why I'm saying it's not a major red flag here at this point. Okay, let's get to the financials. Debt to equity ratio, I look for anything under 1, so at 0.16, that's fantastic. So interesting, they're showing debt levels on here now, on the balance sheet. So let's go into that, because on the other sheet, on the financial health sheet, they showed no debt. So that's interesting. Not sure if it's a data feed issue or what. They have $11.4 million in cash. Very good. Accounts receivable is, again, huge, $46.5 million in the balance sheet. I'm assuming that's going to be most of their balance sheet assets based on their size of about, what was it, $83 million. Goodwill. So this has not gone up over time. Let's go to the annual. Annual, where's Goodwill? So it hasn't gone up in the last 5 years. That is essentially the only caveat. Oops. To the book value going up, if it's due to Goodwill, which I explained in a bunch of other videos, and you can find those for free below. Specifically, I'm thinking the Cody video and the ExxonMobil video. I'm pretty sure I talked in depth about Goodwill and why that going up isn't a great thing, but that's not a problem here because that hasn't happened. Their intangibles have gone up a little bit. I'm assuming maybe they have some IP or they acquired some IP or something like that. That's not necessarily a huge deal, unless it's, of course, ultra valuable IP. Then it's a massive deal. So most of their balance sheet, about 50% of the balance sheet is in accounts receivable, which is orders. That's good. Or it's not really good or bad, frankly. It just doesn't really mean much. Okay, so what they're counting as debt here looks like capital leases. So that's why it didn't show up on the other debt place, because those aren't considered debt, or at least pure debt. They are still things you want to know about those. So capital leases are things like, these are things for most likely equipment or buildings they rent, stuff like that. That's what most capital leases are. So it's not a huge, or it's not a red flag at all in this case because they're such low numbers. But you definitely want to know about them as a full business owner, which is how I look at the company. Again, not a red flag here because they're not huge in amount, especially when you consider they have more cash on hand than they have capital leases for both short and long term. Not a big deal at all in a negative sense. Their liabilities have gone up significantly over time. What about their assets? So their assets, a lot of that is from payables and stuff like that. Again, payables in this case are probably payments for suppliers and whatever they sell. Which frankly, still after even looking at the website, I'm confused about. Very clean balance sheet. Very good balance sheet. Very clean so far. WYY, other than its profit margins, looks like a great potential investment. So let's go to valuation. This is where most companies go to die. And in this case, that is the case for WYY as well. Not necessarily up here. Again, I don't care much about price, PE, price to cash flow, or forward PE, but I want them to be under 20. Want them each to be under 20 to consider the company undervalued. PE currently is 7.8. Price to cash flow is 12.6 rounded up, and forward PE is 34.7. Again, I don't really care much about these metrics, but when I want that, or when I look at them, I want them to be under 20. Not a huge deal here. This is the bigger deal. EV to EBIT. Enterprise value includes debt and cash, and again, as thinking as a whole business owner like I do, I want to know what those numbers are. That's why I don't like price or market cap, because they don't include that number. Since 99% of all companies on earth have either cash or debt or both, I want to know that number. I also care more about EBIT or operating income than I do earnings, which is why I don't really like the PE ratio. Again, I explained this in some of the other videos. Why I look for these numbers specifically, or why I prefer this metric specifically. I go into more detail on that. But what I look for on this metric is anything below 8 to consider the company undervalued. Sorry. Anything below 8 to consider the company undervalued. At 23.04, that means not only is WYY fairly valued, it's slightly overvalued. Is it a huge overvaluation? No. Is it a massive deal to me? Yes. I never buy companies when they're overvalued. At worst, I will consider buying companies when they're undervalued. Or when they're fairly valued, sorry. And preferably, obviously, I want to buy companies when they're undervalued. Is this a huge deal to me? Yes. At this initial stage, yes. Is it a deal breaker like forever? No. What I would do is I'm going to add WidePoint to my watch list. So thank you, Njoomnow. Again, hopefully I'm pronouncing that right. Looks like a great company, frankly, other than the valuation. And, of course, the low profit margins. But, again, that's frankly to be expected in this industry, in the government contractor industry. So what I would do from here is, this is the only second time we've done this, and now it's reminding me that I had this for another company that was fit most of my criteria in eBay. And I said we're going to do an analysis video of that, and I forgot because we've kept looking at companies that I wouldn't consider. So now that I remember that, I'll add that to my calendar as well. I'm going to add this to my watch list, do a full preliminary analysis valuation on a written preliminary analysis valuation, which I'll share with you in another video. But is it a deal breaker now? Probably, but I want to make sure, so I'm going to do the full analysis. If the company still looks like it's undervalued, or excuse me, overvalued there, then at that point I would stop analyzing WidePoint for now, and I would add it to my watch list. For now, it's going to go on my watch list regardless, but that's kind of my process. So WidePoint looks like a great potential investment. I would want to dig into the financials if it gets to that point. Again, I do this process purposely. I purposely do not research companies fully before I dig into these numbers, because I want a minimum margin of safety, minimum requirements that must be met, or I do not go further into the research. I do not want to be biased negatively or positively by any stories out there, or what the CEOs are saying, or what their future is. That comes later, but at first, because the reason I'm answering this is because I got questions on the other videos about that I should have done my research first. I purposely don't dig into financials until later, and I don't dig into what the company CEO says until much later, frankly, in analysis, because again, I don't want that to bias me either negatively or positively. I will not invest in companies that do not have a minimum margin of safety. And that I can tell that by looking at these numbers. So for now, WidePoint goes on my watch list. Going to add it to my calendar to do a full preliminary analysis of WidePoint. Again, stock ticker WYY. Fantastic recommendation here, by the way. Interesting analysis, not just because of this, but also because of the what I got to talk about at the beginning about the word federal. Again, tip. You see the word federal, federally, something along those lines. It's one sign the company might have competitive advantages. Or again, at very worst, long-term contracts that guarantee them to some degree revenues, profits, cash flows. So love this case study. Thanks for the recommendation. Again, Njoomnow. Hopefully I'm pronouncing that correctly. Love to hear your thoughts on this in the comments below. If you're watching, if you see this, would love to hear everyone else's comments below as well. Did I miss something? Did I mess something up? Did I not explain something well enough? Let me know in the comments below. If you want me to look at a stock for you, let me know in the comments below. Again, I've got all of my calendar now. Pretty much every single stock on here for the next 2 months is for somebody who recommended that I look at a stock. If you want me to look at a stock, let me know. Again, I'll look anywhere in the world. Won't look at banks because I don't evaluate them. We'll look at insurance companies because you actually have to dig into the financials to evaluate them. And won't look at companies that don't have any revenue, profits, or any revenue, either, after some recent feedback. So I hope this helps. Hope you found this useful. If you like this content, make sure to like, love, share, subscribe, all that good stuff, and hit the notification bell so you're notified every time we release a new video. If you're listening on the podcast, all that same stuff, we really appreciate it. We'd also really appreciate a review. The more reviews, views, and listens we get to our content, the more people we can help. If you like this content, make sure to check out our free resources below in the description of this video. You can get our 5 free gifts, which includes the full visual or the full written preliminary analysis checklist we're going to go over now with WidePoint. You can get that. And for the free gifts for free, you can also get a free PDF copy of my book, How to Value Invest. And you can also get a free copy of our guide, 7 Tips to Picking Great Stocks 3 Times You Must Sell. You can get all 3 of those for free at the links below. If you're looking for more specific help from me, you can check out our masterclass or information on our masterclass at the links below. And I stuttered there because I realized I forgot to say something earlier. So why should you listen to anything I have to say? When it comes to any investment analysis on this site or on this page, in the first 9 years of my career, I've produced investment returns of 23.5%. That puts me just behind 24.2% average returns Buffett produced, the great Warren Buffett produced in the first 9 years of his career. And those numbers legitimately make me one of the best stock pickers in the world over the last 9 years. Other than that, love to hear your comments, all that good stuff. But until next time, have a great day. Talk soon. Bye.